Good morning. This is Rob McCarthy with 101 Loan, and today I have my good friend Todd Wellnitz and my good friend Nico Wiborg here to talk a little bit about different types of insurance that we all need as we get older. This month I turned 55, and having parents and family members suffering from just things that plague us as we get older, little Parkinson's or Alzheimer's and so forth, little dementia. It really makes me think about how things like long-term care would be a real nice benefit to have right now. And then, of course, as we get older, life insurance as well. And both Nico and Todd are experts in this field. Good morning, Nico. Good morning, Todd. Why don't you guys introduce yourselves?
Todd, go ahead.
Thank you. I'm Todd Wellnitz with Wellguard Insurance and Financial. I'm an independent insurance broker. I call myself a life insurance, long-term care, and disability specialist because that's all we do is we make sure we can get folks to and through retirement. What about you, Nico?
Hello, everybody. My name is Nico Wiborg. I'm with the Silicon Valley office of New York Life. Much like Todd, my sole focus in my practice is the crafty placement of life insurance, disability insurance, and long-term care.
Cool. So we're just going to ask some questions back and forth, a little Q&A this morning, as obviously you guys are the experts. You know, it's funny, I thought I knew about life insurance, and it's one of these things where I've always heard stories like, it's expensive, but I'm learning that it's actually expensive if you don't have the right insurance. I've always heard that, just get a term policy or self-insure. Well, sometimes that could be good, and sometimes that could be very bad, especially with term that expires. So, you know, if the term doesn't match up with when I actually pass this world, my heirs will get nothing. And so, so today we're just going to ask a few questions. And Nico, let's start with you. So, what types of life insurance are out there right now?
Rob, the two main types of life insurance that you'll encounter are temporary and permanent. Neither one is inherently superior to the other. They both have their strengths and perceived drawbacks, but they both have a job to do. So term is referred to as temporary life insurance, and that's typically enforced for a defined period of time and may be found as the most economically efficient way to gain temporary life insurance coverage. On the other side of that, there's permanent life insurance, which has a multitude of benefits. One of the biggest being that you'll make sure the insurance lasts as long as you do. So if you have needs for familial planning, business planning, or even estate taxes, permanent life insurance is a great consideration for you.
And how does one go about learning which one's best for you?
I would argue that nothing replaces a good advisor who puts your interests first, right? The fiduciary standard, the best interest standards, those are there for a reason. So if you can find somebody that will take the time to put together a thoughtful plan for you, whether it be term insurance, permanent insurance, or honestly, no insurance, if that's not a need for you, they'll tell you what's right.
Got it. And then when somebody's kind of trying to figure out how much they need, you know, again, same kind of thing, just someone to take you through the plan and the idea?
Yeah, there's typically two common methodologies for assessing the amount of life insurance that one might need. And, you know, I would say the amount is more important than the type of life insurance, right? If the unthinkable happens and, you know, Todd or I have to deliver a check to somebody's family, they're not going to ask us what type of life insurance it was. They just want to make sure that it's enough for them to take care of their family and their plans. So, you know, one might look at replacing their income over the remainder of their projected working years with the expected increases in earnings and do the math that way. Say, hey, look, if I'm going to work for another 20 years and I make X amount of dollars now and I'll keep making more money, well, this is how much I would need to replace so that my family's plans stay on track. Alternatively, you may take an a la carte approach to it and say, well, I have a mortgage, I have cars, I have, you know, student loan debt, whatever it may be. I want to make sure to pay for my kid's wedding or to be able to fund college at a good school. And you can add all of those things up. And typically the two methodologies come out to a pretty similar number, but either one works depending on what's most comfortable for the client.
Right. Most important thing is that you're actually thinking about it and then implementing it.
Correct.
So, hey, Todd, in talking about the different types of life insurance, do people ever layer the insurance? Do they do different kinds at the same time? What do you see out there?
Absolutely. I was just talking to a client yesterday, and they were thinking maybe I should just buy one plan that would be a one-size-fit-all. And I said, well, let me ask you this. And it was a lady. I said, do you have dancing shoes? Yes. Do you have running shoes? Yes. Do you have snow boots? I sure do. Don't they all three have different purposes? So absolutely, to Nico's point, there's temporary needs, maybe a young family. We need lots of inexpensive term life insurance for the temporary need. But of course, we're not going to pass in the early years. And then in 20, 25 years, we'll let that fall off. And then we have a permanent need through that process for more permanent concerns, if that makes sense.
Got it. And typically, in your experience, what do you see? What do you see when you think of uses for this? What are you seeing them use it for? Is it just to pay off a mortgage? Does it provide income? What are some of the different things you're seeing?
Well, to your end, Rod, a lot of times when people are carrying a large amount of debt, such as a mortgage, they want to make sure that family never has to leave that dream home that the kids are growing up in. So we'll make sure we try to cover most of that so the surviving spouse can stay at home. And then we also look at, like Nico mentioned, other debt, other concerns down the road, college, maybe some retirement planning, which is a very unique concept many people don't hear about. And then, it depends on, do we need some money tax-free as we're moving along the process, maybe for loans for our business or for college. So there's multiple purposes as long as you have the right crafted plans. Okay.
And, one of the things I think that comes up too is like, when's the right time? Like when should I be doing this? When should I be doing that? You have any thoughts on that?
Absolutely. Obviously before you need it, right? The best life, and I was told earlier in my career, the best life insurance policy is the one that you own at the time of your passing. So the key is, I think, make sure that you have some basic planning in place, match your affordability. The worst thing I see out there is people get into bigger plans than they can afford, put a bunch of money into them, can't afford them. Work with a trusted advisor that is a specialist in life insurance. And we can even lock in insurability, meaning you do have to be able to apply for these with your health. So there are some health questions. And so, lock in that ability to have that health preserved for maybe 10 years. Right. So maybe over time you can grow into a policy when you are making a little bit more money.
Right. That makes a lot of sense. So that kind of covers some of the different things to think about with life insurance. Let's talk a little bit about long-term care. Nico, why don't you, best way to describe long-term care, how would you summarize that?
Conceptually, I would say it's a safety net for all of your hard-earned dollars that you've spent your lifetime accumulating. Long-term care provides funding in the event of an extended healthcare event. As you alluded to earlier, Alzheimer's, dementia, Parkinson's, things of that nature, they're exceedingly common. And the older we get, the more likely it is that we're going to need some level of extended care.
Right.
It's not cheap now. It's not going to get cheaper in the future. But what long-term care does is it gives you options. One of the greatest options is that you can choose to let somebody else write the big check because you've been writing the little checks all along. So with long-term care, you maintain the option with most plans to take care in a skilled facility, if that's what's most appropriate, or to stay at home around your loved ones and in familiar surroundings, which most people prefer. I know I myself would like to stay home if I have the choice.
Right.
But again, it provides the funding for you to be appropriately cared for an extended period of time.
Yeah, we actually have a relative right now going through the same kind of thing. She's up in the years, and it's interesting. Physically, she's actually not doing that bad. Just mentally, dementia, short-term memory is going, and it's one of these things where we're trying to figure out, what care is right. and when we start looking at the dollar amounts, people always talk, I've heard people say, clients say, advisors say, well, long-term care is expensive, but it's nothing in comparison to what the actual cost is. It actually kind of fathoms in my mind how parents and relatives have saved money, and quickly, very, very quickly, you can burn through those assets. Whereas if they would have had the insurance in place, obviously they wouldn't be burning through those assets as quickly. So,
Yeah.
Todd, how does one typically pay for long-term insurance? Is it something they pay monthly? Can they pre-fund it? What are some of the different options out there?
Yeah, absolutely. People can pay it monthly, annually. We can also shift assets, and that's what we're finding very successful right now. Is we try to impress upon folks that we work, give up some holidays, some birthdays to work and build this nest egg. And yet, really, what we're exposing that to is potentially a little bit of Parkinson's or just a hint of a stroke. So the idea is we try to find some assets to build a wall around their personal assets. And that wall is built with insurance company money. So sometimes we're shifting, some savings that's, built up a little extra. Maybe people are moving money out of the market because they really want to protect and preserve what they've built up. So there's various ways to actually pay for this. And what we try to show it as more of an investment as opposed to a bill.
Right. No, that's interesting. It seems like, is there a best time to buy? Obviously it seems like based on everything I've heard so far, it seems like it's best to really get this locked in, before you retire, when you're younger. I would think the rates would be lower when you're healthier and younger versus waiting until you're 50 or 60 years old.
Absolutely, Rob. Yeah, life insurance, long-term care, for sure, age and health, they definitely play a significant role. Number one, we want to find out, do they even think that this could happen to them, whether it's a cognitive impairment or physical impairment or someone running a red light and laying you up for 3, 4, 5 years. So if someone believes that potentially that may be something they can't control, then what we really want to do is we want to impress upon them to start looking into how to put a plan in place. And so, really it's obviously before you have that cognitive impairment, that need.
Right.
But the key is we can kind of wrap the two concepts in together. You have some life insurance with a long-term care wrapper. So the idea is you can sometimes take care of two needs in one solution.
All right. And so we talked about life, we talked about long-term care. Nico, tell me more about disability. So does that wrap into this whole thing as well?
Absolutely. When we refer to foundational planning that allows you to take risk and go after all the investments and exciting things you want in life, protection is important. Disability insurance is income protection while we're alive. It's not replacing it after we're gone. Just about everything that we plan to achieve and experience individually or with our families and with our business is predicated on the assumption that we're going to have a continuing and even increasing stream of income.
Right.
If we can't work, that doesn't happen. Not only does that not happen, but if we can't work because of an injury or, as the name would indicate, a disability, there's a good chance that we've also got some medical bills to deal with on an ongoing basis.
Yeah.
So disability insurance gives a continuation to our stream of income so that all of our plans, including our retirement planning and funding, don't have to come to a screeching halt.
Yeah, I've heard clients talk about disability and they say, well, my employer covers it. I go, well, what happens if you get laid off? What happens if you quit? What happens if you have an event? And how long will that actually last? And so all interesting things. One of the questions I had, Todd, for you was, tell me a little bit about, just when you think of insurance, I've heard clients talk about, well, it has a cash value. And then I guess there's other things that there's definitely some tax benefits in relationship to it as well. These are all kind of new things to me. Can you talk a little bit about that?
Yeah, absolutely, Rob. As we get closer to retirement, we start talking about three of the main risks in retirement. It's market volatility, right? Losing money, going backwards,
Yeah.
taxation, and then also longevity risk, living too long, outliving our money. So I wanted to, kind of give a quick example. I met just recently with a 49-year-old female. She was concerned about how many times she went back and forth with her 401k. We educated her on the fact that, that's 100% taxable, and our federal government may be having a hard time with Social Security and Medicare and maybe this national debt and then all this stimulus money. Are you willing to pay increases in taxes in the future? And when she said no, I said, well, maybe we should look at life insurance in a different way. And she said, okay. So long story short, rather than maxing out her 401k, she decided to pay the taxes on that money. And then she invested $15,000 a year for 15 years. And so after 15 years, she was turning 65. And based on a very conservative calculation, she would be able to take out $41,000 out of this specially set up life insurance plan for the rest of her life that she could never outlive. And
Really?
even better, yes, sir. And even better, the federal government would not send her a 1099, and they know all about it. So this is $41,000 off the radar. And the thing about that is I ran some quick numbers, and I said, well, what if hypothetically you live to 90? So you took out 26 years of $41,000. And I know, Rob, you can do the quick math on that, but for everybody else out there, that's $1,066,000 that she can count on that's not affected by any future raises in income tax or capital gains tax. Now, heaven forbid she did pass at 90. Do you know what her family would receive, Rob?
It's all right. It's all right.
Rob, her family would get a little over $308,000 in a tax-free death benefit because it's a life insurance policy,
Right.
but we're using it for tax-free income. So the quick math on that is her $225,000 turned into $1.374 million, totally income tax-free, and that's not something that she's heard from her CPA or financial planner. So that's just one example, Rob.
That's a big deal because I turned 55 in July, and it's kind of interesting. I thought, when you said 15 years, I'm thinking she probably started when she was in 40, 45. But then when you said 65 years old, kind of going, that's interesting. Because a lot of us have a lot of money in our 401ks, and yes, we kind of manage it. But the thing about it is it's just out there. We're waiting for that day. And then it's taxable, and half the times when it seems like financial planners, when they're pulling money, they don't want to pull money from the IRA. It's taxable at a higher rate. And so, they'll use cash. They just don't want to create a tax event. This is a great idea. That's very interesting. Todd, I might call you on that. That's interesting.
Yeah. And I forgot to mention, Rob, that actually there was a long-term care benefit rider in there. So, we were taking care of all three risks: the market volatility, the taxation risk, and her living too long. So just wanted to wrap it up that way.
Oh, that's huge. That's huge. Hey, this has been fun. This has been great. I knew this would be a great topic. If anybody wants to get a hold of you, Nico, how would they get a hold of you?
You can find me on Google or LinkedIn, Nico Wiborg, New York Life. My phone number's there.
All right. And Todd, same?
Todd Wellnitz, on LinkedIn. Also Todd at Wellguard Financial, or just reach out to Rob, Mr. Funded at 101 Loan, and he'll find us as well.
Mr. Funded. Okay, I'll have to create that tagline. What I'll do too is I'll put your contact information below when I post it on YouTube. And hey, I really appreciate your time today, guys. Very informative. Makes me think, 55, the term, it's like maybe not a good idea. Maybe sounds like there's a lot better options out there. So thanks so much.
Thank you, Rob.
Thanks,
Nico.
All right. Take care. Have a good day.
Take care.